Who among you are familiar with the Federal Reserve, the one who acts as financial maestros responsible for keeping our economy in tune and our heads from spinning? You see, their job is a delightful blend of excitement, stress, and enough caffeine to power a small city. Trust me, when it comes to tiring jobs, these folks have got it down to an art form. They implement monetary policies, banking supervision and regulation, financial services, and economic research and analysis. But wait, it's not all praise for the Fed, because according to Roger Ferguson, the former Federal Reserve Chair and the former President and CEO of TIAA, the Fed has more work to do because inflation still presents danger.
Inflation is still very much a clear and present danger. The Fed has more work to do.
To elaborate what Ferguson is trying to say, imagine you're at a grand marketplace where people are trading goods and services. In this bustling market, there's a special booth called the Federal Reserve. Now, the Federal Reserve has a lot on its plate and has become quite busy lately. So much so that the market participants have started to realize this and are adjusting their expectations accordingly. Now, one thing that everyone is buzzing about is the interest rates. Think of interest rates as the price you have to pay for borrowing money or the return you get when you lend your money to someone. The Federal Reserve has the power to influence these interest rates, and it's an important tool they use to control the overall economy. In the video snippet I've shown you, Roger Ferguson mentioned that the market has priced in a 50 basis point number. Now, don't let the jargon scare you. A basis point is just a fancy term for 0.01%. So, a 50 basis point move means a 0.5% change in interest rates. What this means is that the market participants have started to expect that the Federal Reserve might make a significant move and change the interest rates by 0.5%. But that's not all. Roger Ferguson also talked about something called the terminal rate. No, it's not the final stop of a train, but rather the interest rate level at which the Federal Reserve wants to stabilize things in the long run. It's like finding the perfect temperature for a room, neither too hot nor too cold. The market is also trying to predict what this terminal rate might be and factoring it into their expectations. Now, why is all of this important? Well, let's bring it back to real life. Think of interest rates as the cost of borrowing money for big purchases like a car or a house. When interest rates are low, it becomes more affordable to borrow money, and people are more likely to take out loans to buy things. This can stimulate economic activity and encourage spending. On the other hand, when interest rates go up, borrowing becomes more expensive. People might think twice about taking out loans, and it can slow down spending and economic growth. So the Federal Reserve, being the central bank, has the challenging task of trying to find the right balance. They want to avoid an overheated economy with too much borrowing and inflation, but they also want to avoid a sluggish economy with low growth and unemployment. To do this, the Federal Reserve carefully watches economic indicators, studies market trends, and analyzes a ton of data. It's like they have a crystal ball, trying to predict how different moves will affect the overall economy. And the market participants, those active traders and investors in our grand marketplace, are constantly trying to anticipate the Federal Reserve's next move. So when someone says that the market has priced in a certain expectation, it means that the traders and investors have adjusted their strategies and decisions based on their predictions of what the Federal Reserve might do. It's like they've put on their fortune teller hats and are making their bets accordingly. Of course, these predictions are not always accurate, as the economy is a complex and ever-changing beast. The Federal Reserve itself is also cautious and considers various factors before making any moves. They have to take into account employment numbers, inflation rates, global economic conditions, and much more. But realistically speaking, imbalances in the labor market are still clearly evident to inflationary pressures.
What we are seeing is a very, very tight labor market. We're seeing a very uneven economy, with some areas clearly slowing because of rising rates. Think about the housing sector. Yet, I think there's still pent-up demand for services And we see, particularly in some of the low and moderate jobs and services, that there are a number of openings. So this is a fairly unusual configuration for sure, Joe. But the baseline is imbalances in the labor market are clearly still feeding into inflationary pressures that, while coming down very gradually, are still very much above the Fed's 2% target.
To help you understand the situation, think of these imbalances as a seesaw game at the carnival. When one side is much heavier, it throws the balance off. In the labor market, imbalances occur when there's a shortage of workers in certain industries, causing wages to rise rapidly. This can lead to higher costs for businesses, and they might pass these costs on to consumers in the form of higher prices for goods and services. These rising prices are what we call inflation. Just like the cost of carnival tickets going up, inflation means that the prices of everyday goods and services increase over time. The Federal Reserve has set a target of 2% inflation because a little bit of inflation is considered healthy for the economy. However, the statement notes that inflation is still above the target. It's like the carnival games giving out more prizes than they should. Things are getting a bit out of hand. So why does the Federal Reserve care about all of this? Well, just like a vigilant carnival manager, they want to ensure that the rides are exciting but not too dangerous, and that everyone can enjoy the carnival without breaking the bank. The Federal Reserve's job is to maintain stability and balance in the economy. To tackle these challenges, the Federal Reserve has tools at its disposal. One of these tools is adjusting interest rates. They can lower interest rates to encourage borrowing and stimulate spending when the economy needs a boost. On the other hand, they can raise interest rates to cool down an overheating economy or combat rising inflation. In our carnival analogy, imagine the Federal Reserve as a skilled tightrope walker, delicately balancing on a high wire. They need to make sure the economy doesn't tip too far in one direction. If they move too quickly to raise interest rates, they might stall economic growth. But if they wait too long, inflation could become a problem. It's a tricky act of timing and precision. So when the statement says that the Federal Reserve has a lot more things to do, it means that they have their work cut out for them. They need to carefully navigate the tight labor market, address the imbalances, and bring inflation down to their target of 2%. It's like the carnival manager trying to make sure the rides are running smoothly, the lines are reasonable, and the prices are fair. To truly harness the power of the Federal Reserve, it is crucial that we actively engage with financial planning and budgeting. By proactively managing our finances, we can navigate the uncertainties that arise from the Federal Reserve's decisions. Establishing solid budgets, maintaining emergency funds, and diversifying our investments can provide a buffer against economic fluctuations. Moreover, seeking advice from financial professionals and staying informed about market trends can help us adapt our financial strategies in response to changing economic conditions. While the Federal Reserve holds significant sway over our economic stage, it is important to remember that we, as individuals and businesses, have agency in this narrative. By understanding the Federal Reserve's role and staying informed, we can proactively adapt and make sound financial decisions. Through careful planning, budgeting, and a willingness to embrace change, we can navigate the economic waves and ensure our own financial well-being. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Zoo channel. I'll see you in the next video.